Okay, welcome back again for our next Wealth Building Strategies workshop on asset-based lending. One of the unique features about asset-based lending that other investments don't have is the ability to create your own discount. So, for example, a real estate investor that is going to purchase a home to fix and flip, they've got to buy that home at a discount with the ability to do renovations and still have a profit margin. Whereas a lender can dictate what their exposure is that they're comfortable with on a particular transaction. So for example, if the lender wants to have no more than a 60% exposure, they simply discount the amount they're willing to lend to $60,000 on a $100,000 home, and they've got a secured investment against a hard asset at a discount that they created that the real estate investor is willing to work with. So if you needed $70,000 and the lender was going to put up 60, that means the real estate investor would have to come to the table with $10,000, so they have some skin in the game and they're still protected by an additional 30% equity. So it's a unique strategy, and wanted to talk a little bit about some of the benefits. And first we're going to go over some terms and definitions. A little bit about DMI Holdings. DMI Holdings is a privately held equity investment company which provides investors a relationship-driven, trustworthy, and profitable partner who implements alternative strategies for growing wealth. We build lifelong relationships with our clients by being transparent and by using a disciplined, research-focused approach with the objective to produce consistent above-market returns for our investors. My name is Eric Mattingly. I'm the CEO and founder of DMI Holdings. Those of you that have been watching the workshops know a little bit about my background, but I started out in the martial arts industry, started investing in real estate when I was about 28, wound up going into the private capital industry due to a lot of serious injuries I sustained over my career. I've been involved in a little over $1 billion in investment transactions over the years, and done many different types of real estate projects, a lot of private and hard money lending, as well as some business expansion opportunities and opportunistic assets. So just some lending terms and definitions to be aware of to understand some of the different aspects and terminology. Lending is a pretty simple investment. That's one of the things that I like about it. I like to do private lending myself, and I'm willing to exchange potential upside on my money for a fixed secured return. So assets is just simply anything of value, whether it be real estate, it could be a guitar. I did a loan to a guy and secured a rare guitar. I took to Guitar Center and got a valuation and just simply lent an amount less than what the guitar was worth that they'd be willing to buy it for. So the guy actually defaulted on the loan, and as soon as I was ready to go to the Guitar Center and trade his guitar in for cash, he somehow came up with the money. So that's one of the things that's nice about doing secured loans versus unsecured loans. A bridge loan is simply temporary financing until more permanent financing is available. We work with a lot of individual investors that do bridge financing for us for doing acquisitions. So we may need to come up with all of the capital to close relatively quickly to allow us time to put together a private placement offering and raise the capital from the permanent equity investors. So we may have a bridge lender or a couple of bridge lenders put up the needed capital and give us an opportunity to close. Those bridge lenders are generally receiving a pretty high interest rate on their money, 10 to 12%, sometimes 14, depending upon the time. They may be origination points or exit fees, and that would be the return they get, and then the equity investors actually participate in the project. Depending upon how much bridge financing is needed, in some cases we've had for a lower interest rate for the lender that they provided us, we also may give them a participation or a carried interest in the deal. But their downside is protected by the interest rate that they're charging. Collateral is just simply assets pledged to secure the repayment of the loan. And again, this doesn't just have to be real estate. Anything that's of value that you can sell can be used as collateral to secure a loan. Debt is just simply the amount owed for funds borrowed. And again, you can dictate the exposure limit that you want. You can't do that with other investments. Debt service is the amount of the payment due regularly to meet the debt agreement. We've done a variety of types of loans with investors. Some investors will allow us to do an accruing interest loan. This just helps with not having a monthly debt payment. In the case where we're raising capital that takes out the debt, most investors are amenable to that. If it's a loan that's going to be out there for a longer period of time, the investors may want to have that loan serviced on a monthly basis. In some cases, there's a debt service reserve required. So if the lender wants to ensure that payments are made, a lot of hard money lending funds and companies out there will require a debt service reserve, and this is just a reserve that's used to repay debt in the event that cash generated by the operations is insufficient. So you may have a 12-month interest reserve. The lender is then pulling from that reserve, and it's part of the loan. So the borrower is actually paying interest not only on the money borrowed, but also on the money that needs to be held aside for the debt service reserve. Due diligence is the task of carefully confirming all critical assumptions and facts presented by a borrower. So if you are going to secure your loan against a hard asset and you don't know exactly what that hard asset is, you may be collateralizing your loan against something that doesn't have any value. So you definitely want to make sure you understand what the collateral is and the value of that collateral so that you're lending at a discount to that collateral value and to be able to mitigate and reduce your risk and your exposure on the investment. Equity is simply the value of the property greater than the total debt held on it. So $100,000 property that has a $70,000 loan, the equity on that property is 30% or $30,000 in that case. If the lender wasn't comfortable with a 70% loan to value, they may offer only 60%, and then the equity would be 40% or $40,000. Interim financing is short-term loans, is a short-term loan to provide temporary financing until a more permanent financing option is available. And this is sometimes done by banks. And when you're stabilizing a property, they may have interim financing that then converts to conventional loan. There's limited liability, so the limitation of the shareholders' losses to the amount that's invested. Loan to value is what we were discussing, is a lending risk ratio calculated by dividing the total amount of the loan by the appraised value of the property. And again, lending, unlike most other investments, you simply can set what your risk tolerance ratio is and can control your own discount. The principal is the amount that is received in the case of a loan, or the amount from which flows the interest. So if you have a $100,000 loan on a $200,000 property, for example, your principal is the $100,000 that you put up as a loan secured by $200,000 of collateral. Preferred equity kind of acts like debt in some cases, but stock shares that have preferential rights to dividends or to amounts distributable on liquidation or both are ahead of the common shareholder. So let's say you're doing a $20 million apartment complex, for example, and you need $5 million of equity. You may have a preferred equity investor that puts up $4 million, and then the equity investors put up $1 million. So first, the debt on the property would have to be satisfied upon liquidation. Then the preferred equity would be behind the debt, and then the equity or the common shareholders would be behind the preferred equity. So the preferred equity is subordinate to the first lien or the debt. Recourse, so there's full recourse loans and there's non-recourse loans. A full recourse loan refers to the right of the lender to take any assets from the borrower if repayment is not made, and a non-recourse loan limits the lender's rights to the particular asset being financed. So if you're doing a construction project, let's just say multifamily, then while you're doing construction, the loan is recourse. Once you complete construction and you start leasing it up, the recourse loan would then convert to a non-recourse loan. If you purchased an acquisition of an existing property that has stabilized income, you're generally going to be getting a non-recourse loan, which means that first of all, it doesn't go on your financial statement as a liability, and the security is limited to the property. They can't come after the individual unless they violate what's called bad boy carve-out clauses. Security is just a pledge made to secure the performance of a contract or an obligation. Example of securities include real estate, equipment, stock, or a cosigner. You might have a person with a large balance sheet that also co-signs on the loan to provide additional security. Senior debt is debt that must be paid before subordinate debt, and subordinate debt is considered junior debt, and the debt which senior debt takes priority, junior debt is in front of the equity. So if you were to sell a property, you would pay off the first lien, then you would pay off the second lien. If you had preferred equity investors, they would be next, and then your equity investors would be last. Based on the position you sit in is also going to dictate the kind of rate you're going to charge or return you're going to make. So your equity investors, they're taking on the majority of the risk, and therefore they wind up with a potentially much higher and more substantial return than first lien holder, for example. So asset-based lending, some benefits and options. Why asset-based lending? Today, many investors place their investment money in real estate. You can obtain higher returns than you can with conventional investments. From the downfall of the stock market, people are looking for other options that are a little bit more predictable. A lot of the corporate scandals and frauds that have gone on, and allows investors to be able to earn predictable, stable, and consistent returns by collateralized lending. Private lending is thousands of years old, dating back to biblical times. It's one of the, I'd say, first and original investments out there. Long before all major banks, credit cards, and finance companies, individuals borrowed money from others in exchange of interest payments. So a private lender is someone who lends money to a real estate investor who will buy a property at a wholesale price and below current market value. You can use other collateral, as I mentioned before. The private lender is in a control position and is basically acting as the bank. Your loan is secured against that real property, whatever it may be. There's a lot less worrying than the stock market because the investor, the lender, gets a fixed return. Going in what your return is going to be, and then you have your investment secured against the collateral. And if the lender or the borrower doesn't perform to the lender, then you can take the property back and liquidate it to be able to get your capital back out. And it provides the opportunity to make a higher return with rates offered by other investments with much less risk. Again, I love private lending myself, asset-based lending, and although as an equity investor you can potentially get substantially higher returns, if you're making 10%, 12% on your money, and you can consistently do that over and over again, it doesn't take a very long time to really build some substantial wealth and or create an income stream for yourself. And you compare a, asset-based loan against a fixed rate annuity that also produces income, you might get 3 or 4% on an annuity. So if you have $1 million in a fixed rate annuity at 4%, you're making $40,000 a year versus a secured asset-based loan where you're making 12%, 1% a month. That's $120,000 a year secured against collateral versus 40. So you get a lot more bang for your buck and with relatively low risk. A borrower can pay down debt, pay off debt, or restructure debt. Investors can reduce their risk by funding small portions of multiple loans instead of simply funding a single loan. Again, we talked about this in previous workshops. You want to lend money or invest money based on an amount that's suitable for your assets. If you're a single investor doing a single loan, and it's not a securities transaction, you can lend as much as you want to. That doesn't necessarily mean it's the smartest thing to do. So if you got $1 million net worth, you may not want to expose your net worth to more than, say, 10% or $100,000 on any particular loan. So you definitely don't want to invest all of your money into one note. I'll just give you an example. A friend of mine has got about a $3 million net worth. He wound up doing a hybrid structure loan with an equity kicker on a single-family renovation project, and he put up $500,000 basically he had out there. The guy didn't perform, and although he turned out okay, he had to go and foreclose on the property, take it back, hire in all the people, finish the construction, and it was also a pretty large, it's 20% of his, total net worth, or close to it. And so you don't want to overexpose yourself. If he had $1 million net worth and he put up $500,000, that's 50% of his net worth on an investment you're wanting to provide income. And although you can get your capital back out, take over the project, that does take work and time. And at the end of the day, he was able to liquidate the property, and he did better by taking it over than on just the loan alone, but it also took a lot of work to make that extra return. But so just something to consider. Another thing is available for investors is to use their retirement plan. So you can use a self-directed IRA, 401k, self-employed pension fund, KEO, any type of retirement plan can be self-directed and allow you options to do things like secured lending. So you can use your retirement plan and give yourself some options other than just stocks, bonds, and mutual funds. So retirement account holders can self-direct their funds into a wide variety of investments, including private loans. I've got a workshop on advanced self-directed IRA investing where we talk about some really interesting strategies where you can utilize your IRAs. We'll talk about in a later workshop. These self-directed accounts enable investors to diversify their portfolio into potentially more secure and lucrative areas outside the volatile stock market. Quick closing and cash money. So real estate investors need to be able to close quickly. So a lot of people wonder, why would a real estate investor pay 10%, 12%, 14%, and maybe even origination points for use of funds to be able to do a real estate transaction. Quite frankly, it has to do with the ease in which to close and the speed in which they have access to capital. Normally, when a good deal comes up, you may not have a lengthy period of time to be able to tie it up under contract and close on it. So it's the ability to close a real estate deal quickly over having to wait weeks or sometimes months for a typical bank loan approval, and is a huge advantage for real estate investors. Most private money or hard money lenders that lend to people that fix and flip homes, they're not really that concerned about the individual and their credit worthiness. They're really making the loan based on the collateral and the experience of the real estate investor to be able to execute on their business model. The speed and the availability of quick cash gives private lenders a competitive advantage over other investors. Just typical banks generally can't move quick enough, and there's too much red tape. and real estate investors would rather pay a little bit more, lose a little bit of profit for the ability to close quickly and increase their volume. So cash offers will allow real estate investors to buy properties at a very good price and to deal directly than to deal directly with the banks, working with a private lender. So you can build wealth with a secure, profitable, and hassle-free investment. Private money loans are among the most consistent, secure, and predictable ways to earn high returns. We've done literally, hundreds of millions of dollars in bridge financing and private loans on projects that we do where we've got to come up with the capital quickly, or we're raising the capital and we've got a closing date coming up and, we're $2 million short, and that's when we might work with one of our bridge lending investors that will put up the capital to allow us to stay on schedule and not have to extend and give us the extra time to continue to raise the capital to pay the loan off. The private lender is in control of his money, and it is an investment that's easy to understand. We were talking about this in the last workshop. You want a confused mind should say no. If you don't understand the investment and how you can make money or lose money, you shouldn't do it. Lending is pretty simple. If you've got some collateral and you understand the value of the collateral and you lend at a discount to the collateral, and you have collateral that is able to be sold. If you have a rare dodo bird you've secured your loan against, you may have trouble liquidating that rare dodo bird. So you want to secure your loan against something that's easily sold. And then getting fixed returns and having a team of real estate professionals who take care of the investment is better than worrying about the ups and downs of the stock market and having absolutely no control of the direction of your money or the returns you're going to make. So a private lender that invests passively can safely get double-digit fixed returns. That doesn't mean that you just lend blind. You do need to understand the collateral to make sure you understand what you're secured against to ensure you have success as a lender. And with that, I want to thank you for joining us. If you want more information about DMI, you can go to our website, www.dmi.holdings.com. If you have questions or are interested in learning about investment or lending opportunities with DMI, just email us at invest@dmi-mgt.com. Again, it's invest@dmi-mgt.com. We'd love to get an opportunity to talk with you and show you some of the options we have for investors to participate on. Thank you so much for your time.